Hello everyone, Professor Christensen here with our Chapter 9 overview for financial accounting, where we're going to take a look at property, plant, and equipment and intangible assets. So 3 of our learning objectives have to do with the whole life cycle of property, plant, and equipment assets, starting from when we buy them. So measuring the cost of the assets, then accounting for depreciation using 3 different methods, journalizing entries for the disposal of plant assets, and then finally accounting for intangible assets. So property, plant, and equipment is generally put into these 4 categories, or these 4 accounts: land improvements, building, and equipment. Land is kind of self-explanatory, right? Probably look out the window and you can see some land. Land improvements have to do with items that are added to land that don't live forever. So for example, fences or paving, things like that. And the difference between land and land improvements: land, of course, is not depreciated, and land improvements are. Building is kind of self-explanatory also. That is any kind of building the company owns. And then equipment encompasses a whole bunch of different things, like computers. It could be vehicles, it could be machinery, could be furniture and fixtures. Any kind of thing like that would be considered equipment. So these are tangible, long-lived assets. They have to be used in the operations of the business to be considered property, plant, and equipment. So for example, if the company had land and the land was held for an investment as opposed to maybe housing a building on it where they did operations, then you would not include that in property, plant, and equipment. That would be an investment. The cost of property, plant, and equipment includes all of the expenditures that are needed to acquire the asset and prepare it for its intended use. So everything that you need to buy the asset and get it ready. Let's look at some examples. So for land and building, the things that would be included in cost, this is not an exhaustive list. This is just some examples of things that might be included in cost: to purchase price, attorney's fees for like the closing costs, real estate fees, clearing the land, back taxes. You might also have title insurance expenses. So things like that would be part of the cost of your land and building. And then your equipment, you would have your purchase price, sales taxes. You might have delivery costs, transportation, insurance when it's in transit, so it's on its way to your company, and possibly testing and installation. Now, sometimes companies buy more than one asset at a time for a single price. And that's what we're going to take a look at here. Now, what we're talking about is not identical assets. So, for example, if a company bought, say, 3 delivery trucks and they paid $210,000 for the 3 delivery trucks, and they were all identical, you would just divide the $210,000 by 3. You would have $70,000 for each of the trucks, right? That's not what we're talking about here. Here we're talking about different types of assets that depreciate at different amounts of time, and they're worth different amounts, so you have to allocate it out to the different assets. So let's look at an example. Sanchez Company purchased land, building, and equipment for a lump sum price of $150,000. The fair value of the assets is land $75,000, building $100,000, and equipment $25,000. So the first step is to add up the fair value of all the assets purchased, and that gives you the total fair value purchased. So we add up the 75, the 100, and the 25, and that gives us a total fair value purchased of $200,000. Notice that that is different than the purchase price, because of course if it was the same we wouldn't have to do this allocation, right? So we paid $150,000 for assets that are worth $200,000. Next thing we're going to do is find the percentage that each of the assets is of the total. So we're dividing the value of each of the assets by the $200,000 total, and those are giving us percentages. Then we multiply that percentage by the cost, the total cost, the $150,000 that we paid to get the amount allocated to each asset. Now, you could skip this step here of getting a percentage. You can just take the 750 divided by the 200 times the 150. If you're okay with that, that's actually easier, and it may give you a better number, because sometimes we might have rounding. These are nice round numbers, but sometimes you might have rounding. So here we have the three amounts allocated to the land, building, and equipment. To check to make sure that you're right, you add up the three numbers that you allocated, and you should get the total to be your purchase price, which was the 150. Now, after you buy assets, you might have to spend some money on them. So, for example, if you have a car, you have probably spent some money on your car, other than just to put gas in it, right, and insurance. So, capital versus revenue expenditures talks about the different kind of expenditures that can occur after the asset is in use. So a capital expenditure is one that is capitalized, and by capitalized, that's what we were just looking at with cost. That means the amount of money that we debit to the asset account. Capital expenditures increase the asset's life or make it more productive. So an example would be your delivery truck dies and you have to put a new engine in. So the cost of the new engine is going to be probably a few $1,000s, right? That would be debited to the asset, so debited to the equipment account. Contrast that with doing an oil change on a truck. That's not going to extend the asset's life, and so that would be recorded as expense, like a repairs and maintenance expense. Now let's take a look at depreciation. Remember from when we talked about adjustments that depreciation is the allocation of the cost of an asset over its useful life. And we're going to take a look at three different methods of depreciation. There is straight line, which is the most common. There is activity-based, which is based on how much you use the asset. And then there's double declining balance, which is an accelerated method. Accelerated means you take more depreciation in the early years and less in the later years. A couple of terms that are important when we're doing depreciation calculations. One is depreciable cost. And depreciable cost is cost minus residual value, because we don't depreciate the residual value, right? We only depreciate however much the asset cost us minus the residual. And when you're all done depreciating, the amount that's shown in your account, in your asset account, is equal to the residual value of the asset. Book value is equal to the cost of the asset minus accumulated depreciation. And we're going to be using these in our calculations. So straight line, I said, is the most popular. It's the simplest. You take the same amount of depreciation for each full year. And that amount is equal to the cost of the asset minus residual value divided by useful life of the asset in years. Now, generally speaking, companies do not buy assets on January 1st. So if you're working on a calendar year, and you have a partial year, then you would multiply by the fraction of a year. There are also some other conventions, like a half-year convention, where the company would take a half year in the first year, no matter when they bought the asset. That's another possibility. But if we were looking at a partial year and we needed to multiply by a fraction, if you say you bought an asset on November 1st, and you were at December 31st, then you would have to take your annual straight line depreciation and multiply that by 2/12, 2 months for November and December. Now we said activity-based is based on how much the asset is used, so the amount is different every year. And a good example of this would be a vehicle, right? Vehicles their life has to do with how much mileage they're driven, right? So this could very well be depreciation rate per mile. It could be how many units a machine produces. But you take your cost minus your residual value and you divide by useful life, but instead of useful life in years, you have useful life in units. And you don't stop there. That's some mistake sometimes students make. You don't stop there. Then you take your depreciation rate per unit and multiply it by the number of units used or made that year. So for example, if this was a depreciation rate per mile, you would multiply it by the number of miles driven that year. The third method we're going to look at is double declining balance depreciation, which I mentioned was accelerated. You take more in the earlier years and less in the later years. And in the US, our tax depreciation is also an accelerated method. So the way you do double declining balance depreciation is you multiply the book value at the beginning of the year by twice the straight line rate. So if you had an asset that, say, was a 10-year life, you would depreciate 1/10 a year by straight line, or 10%. Multiply that 10% by 2, and you would depreciate 20% a year. Now remember, double declining balance, don't deduct residual value, okay? Because we would depreciate down to residual value. Okay, you can pause this for a minute. There are 3 different videos here to help you with some of the details of depreciation. The first video is an introduction to depreciation. The second one walks you through some straight line depreciation calculations. And the third one goes through all 3 methods of depreciation. You can also find those on my YouTube channel. All right, so now when you get to the end of the asset's life, we have to account for the disposal of the asset. So either we're going to just toss it if it's no good, or we're going to sell it. So these are all the steps we have to go through to record the sale or disposal of an asset. The first thing we do is we update the depreciation. So generally speaking, depreciation is recorded at the end of a period. So let's say you have a calendar year and you depreciate it till the end of whatever year. Anyway, you depreciate till the end of the year. It's December 31st, right? You depreciate to December 31st. Let's say the next year you sell your asset on March 31st. So you have to record your depreciation for January, February, and March and update it. Then you're going to remove the asset from the books at cost. So however much the asset originally cost you, you're going to credit that amount. So credit, say, equipment. Then you're going to remove the updated amount of depreciation. So however much depreciation you had on December 31st, plus what you just added up to the March 31st date, you take that out of the accumulated depreciation account by debiting it. You record any cash received, you debit that, right? Because you're getting cash. Cash goes up, we debit it. And then you record a gain by crediting a gain, or a loss by debiting it. Now gains are like revenues. They increase your equity, so they have a credit balance. Losses are like expenses. They reduce your equity, so we debit them. When you're all done, you're going to have a few debits and credits. You're going to check that your debits equal your credits. So this way you know that hopefully you have your debits and credits in the right place. All right, now let's look at calculating the gain or loss on disposal. So the first thing you have to do is find out how much accumulated depreciation did you have on the date of the sale, if it's not given to you. Now, if it's given to you, no need to worry about it. But if it's not given to you, then either you have to calculate the whole depreciation from the time that you bought the asset, depending on how the information is given to you, or you calculate the updated depreciation like I mentioned before. So if you have the depreciation up to the end of the prior year, then you just have to calculate the amount of depreciation to the date of sale and add that to the previous amount. Then you're going to calculate the book value, which remember I said was cost minus accumulated depreciation. And we're going to compare the book value of the asset to the selling price. If you're selling your asset for less than the book value, you're going to have a loss. If you're selling your asset for more than the book value, then you're going to have a gain. So try to think of that in terms of your own assets. Imagine that you buy something and then you sell it. So if you sell it for more than you bought it for, then you're going to have a gain, right? So it's the same kind of idea, except that we're using book value instead of cost. And then again, as I mentioned, gains have a credit balance and losses have a debit balance. Now let's take a look at intangible assets. There are generally 5 types of intangible assets, and some of these assets last forever and some of them have finite lives, right? They all are long-lived assets with no physical substance, and the existence is usually based on a legal contract. Let's look at one finite versus infinite life asset. So a patent in the US protects the inventor of a product or idea for 20 years. Now, the patent might not be good for 20 years, so always make sure that when you're amortizing, which we'll look at in a minute, you amortize over the asset's useful life. But a patent is good for 20 years. A trademark, on the other hand, is good forever, right? So, for example, if imagine the Apple trademark, right? Picture of an apple with a little bite taken out of it, or the golden arches for McDonald's, those are trademarks. Those last forever, so they're not amortized. Now, what is amortization? Amortization is like depreciation, but instead of depreciating property, plant, and equipment, we amortize an intangible asset. And so it's the allocation of the cost of the asset over its useful life. Generally, it's straight line with no residual value. And there's no such thing as accumulated amortization. We just credit the asset directly. So if we were amortizing a patent, for example, you would debit amortization expense and you would credit the patent. All right, so that's all I have for you. Please watch the rest of the videos that will help you with some of the concepts in this chapter, and I'll see you next time.